Real estate is one of the best places to invest your money and build your wealth, and in this video I'm going to be going over some of the things that every real estate investor needs to know. What's up everybody, I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. I fell into real estate investing almost on accident. I grew up in a traditional Indian house, and like many traditional Indian households, I was told that if I wanted to become successful, I needed to become a doctor. So that's the route that I was going on, and when I was in college, I was studying for the MCAT, the Medical College Admission Test, which is the test you take to get into medical school. And while I was studying for this test, I had some money in the bank because I was running some side businesses, but at the same time, this was when the real estate market had collapsed. This was after the 2008 real estate crash, and so real estate prices were at rock bottom. And so I would go on to the financial news websites, and every financial news website was talking about how real estate prices are rock bottom and real estate prices are crashing, and I didn't really understand what that meant at the time. But at the same time, every book that I read about money said that wealthy people invest in real estate. Now, I had no idea what that meant because I didn't know any real estate investors. None of my family invested in real estate, so I didn't know what real estate investing was. All I knew was, according to these books, wealthy people buy real estate, and then these real estate investments pay them with cash flow. Now, this put me in kind of like a sticky situation because I'm spending my entire day in the library from morning to night studying to get into medical school, but at the same time, every time I took a break, I would go onto these financial news websites, and all I'd keep hearing is about how real estate prices have crashed. So I decided, what the heck, I'm already bored of studying, so how about I take some breaks here and there to look at some real estate properties, because maybe I could use it as an opportunity to buy a real estate investment property. On August 22nd, I took my MCAT, which was a whole day exam, and then August 23rd, one day later, I closed on my first investment property. It was a small condo, and this property was my first time investing in real estate, and this is where I first started to get my exposure to real estate investing and this whole idea of cash flow or passive income. That was also when I realized that my heart wasn't set on medical school, so I didn't go to medical school, and instead I became an entrepreneur, and I went to law school, and I became an investor. Now, I've seen real estate investing from a few different lenses. I'm a real estate investor, I'm an attorney, and I'm a real estate salesperson. So in this video, I want to go over some of the things that you need to understand when it comes to investing in real estate. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. Here's how real estate investing works on a very broad general level. So let's assume that you go out and you buy this property. I'm going to assume that it's a home for the sake of this example. And now, instead of you living in this home yourself, what you're going to do is you're going to buy this home, that way you can rent it out to other people. So you buy this home, then you're going to find this nice couple, and they're going to move into your home. But we can't finish it right here because we got to make sure that we add a nice mustache, and for our female followers, a nice braid, or as we like to call it in my native language, Punjabi, a gut. So you find this nice home, and now what's going to happen is you're going to rent this home out to this nice couple, this nice family, and in exchange for these nice people living in your property or using your property, if we're talking about a retail space or an office space, they're going to pay you rent every single month. This is what real estate investing is. Real estate investing is not finding a beat up property, renovating it, and then flipping it. That's real estate flipping. And you can make money doing real estate flipping, but that's not real estate investing. When we're talking about real estate investing, we're talking about buying and holding. Finding a piece of property, whether there's a home or an apartment complex or an office building or a mixed-use building or a retail building, you're finding a piece of property that you're buying to generate income from, to generate cash flow. Because once you own the property, you own an asset. And as soon as you own this asset, you can rent it out to somebody else so somebody else can use or live in your property, and now they're going to pay you rent every single month for living in and using your property. There are three main reasons why wealthy people love investing their money in real estate. The first is cash flow, what I just talked about. When you buy real estate, you're buying a cash flow producing asset. You own this thing that will continue to generate you cash forever as long as you continue to hold this asset. The second reason why wealthy people love real estate is because of the tax breaks you get with real estate. So as an attorney who is not your attorney, because if you have specific legal questions or tax questions, you should be sure to talk to a professional in your area. But in general, our United States tax code gives a lot of preferences and tax breaks to people who invest in real estate. Why? Because that's what the tax code says. So you as a real estate investor are able to generate cash, are able to generate money through these assets, and you're able to pay less money in taxes legally because you get these extra tax breaks thanks to the fact that you're a real estate investor. And the third reason why wealthy people love investing in real estate, because real estate is a store of money. because as we all know, if you've been subscribed to our YouTube channel, our cash is essentially just paper. The United States government and the Federal Reserve Bank can print trillions of dollars on command, and as more and more money is printed, the value of our dollars get diluted. But when you own real estate, you own something physical, you own something tangible, you own land, you own bricks, you own this property. So you own something that you can see, feel, and touch, and something that you can control. And so for wealthy people, this is a way to store money, because storing your money in cash isn't always the smartest thing to do, especially if we're talking about a lot of cash. Yes, you need to have some savings, but wealthy people want a place to store their cash, that way their money is safe. Now, one of the first questions that come up when people want to be real estate investors is, how do I find a good property? And it really doesn't have to be super complicated, because what you want to look for is the good location. You want to look for a place where people want to be and where businesses are moving, because that's where the money is flowing. If money is flowing into the area where your property is, well, now people are going to want to live there, and if people want to live there, well, now your rents will be supported, and maybe you'll be able to even raise rents because more people want to live there. The thing that makes real estate investing really different than investing in the stock market is, when I look at real estate investments, I don't care what's going on with housing prices or real estate prices. If real estate prices go up, that's great. If real estate prices go down, oh well, because when I'm investing in real estate, I'm investing for cash flow. I'm not investing for appreciation. The reason why I'm investing in real estate is because I want to generate this consistent cash flow every single month. So if real estate prices go up, yay, that's nice. If real estate prices go down, well, it doesn't matter that much, because I'm investing for this cash flow. So when you're trying to find a good location, what you're looking for is, where are the businesses moving to? Where are young people moving to? Where do people want to live? And this doesn't always have to be done through super formal analysis. Some simple things that you can do is just drive around different neighborhoods. Where do you see new businesses popping up? Talk to city halls. What new businesses are coming? I was walking around a neighborhood in Chicago the other day with my wife, and we were talking about real estate investing and whether this would be a good area to invest in, because we had never been here before. And one of the easiest things you can do, remember, is just looking at what new businesses are popping up. And I was walking along, and there was a small little downtown, and there were some new shops that said opening soon. And one of the shops that said opening soon was an Orange Theory Fitness. And I was like, okay, well, what I know is Orange Theory, before they open up a new shop here, is probably going to spend a lot of time and a lot of money researching the area and checking out the demographics, and they want to see, where are people who can afford their services. And so if they're investing in this area, they've already done that research. So what you can do is just kind of piggyback off of these companies. If you start to see these name brands popping up in an area, well, chances are these name brands have already spent the time and the money doing the research in the neighborhood, and they think that it's a worthwhile investment for them. And if you're just starting to see it pop up, well, then this could be an opportunity for you to move and invest your money into an area that is starting to come up even more. Once you understand the neighborhoods where you want to be, this is where you got to analyze the numbers. And I'm not going to sit here and sell you on this idea of no money down real estate, because the no money down real estate model comes with a whole lot of risk. And personally, I have bought many real estate deals, many of my best real estate deals, from people who bought real estate with no money down, and they didn't know how to manage their property very well. So then they went into foreclosure, and their banks forced them to sell their property at a huge loss. And that's where I came in, and I was able to buy their properties for pennies on the dollar. And so if you want to be a real estate investor, I want you to be a smart real estate investor and buy things that you can afford, and buy the properties that are going to produce enough cash to pay all the bills and put some money in your pocket. The way you analyze a real estate investment deal is, you take your rental income, and then you subtract your taxes, your insurance cost, your maintenance cost, because every real estate property is gonna have maintenance issues, taxes, insurance, maintenance, your management fees, because I don't want you to be in the business of unclogging toilets. I want you to be an investor and have somebody managing the property, so this can be passive cash flow for you, so you can focus your time on finding more investment deals and doing other things that you love, instead of spending all your time trying to manage this property. And then you can factor in a vacancy cost, because there's gonna be a time where tenants move out, and so you gotta factor in that cost, because there's gonna be times where a tenant is not paying you rent. Once you add all these things up, this is gonna leave you with your net income. Now, if you bought a property with all cash, then you're done. This is all your profit. But if you're not buying a property with all cash and you have debt, this is where now you also have to pay your debt payment. You got to pay your bank back. So now you subtract your debt, and now this is what is going to be your profit. So this is how you calculate the return on a real estate investment deal, and let's run through some actual numbers. For the sake of this example, let's assume that you're buying a single family home, a small entry-level single family home, and let's assume that you buy this home for $150,000. If you buy this home for $150,000, let's assume that you can also rent it out for $1,500 a month. So you buy this home, you rent it out for $1,500 a month. First thing you gotta do is you gotta pay your taxes. This might cost you around $125 a month. Then you gotta pay for your insurance on a $150,000 property, maybe $75 a month, minus maintenance, another $125 a month, minus your management fees. Your management company might cost you right around $100 a month. And then you can factor in a vacancy cost. And for the purposes of this example, let's assume that this costs you right around $125 a month. If we add all these costs and these expenses up, this is going to leave us with a net income of $950 a month. So let's assume right now that you bought this property all cash. You didn't take out any debt because you had $150,000 extra in your bank account. Now this property is putting $950 into your pocket after paying all of your expenses. Now we'll go back to the debt issue in just a second, but if you take this $950 that you're making every month and you multiply it by 12, that means this property is making you right around $11,400 a year in profit. This is where you want to know, is this a good return or not? And the way you can calculate that is by comparing it to how much this property cost you. If this property is making you $11,400 a year and you paid $150,000 a year for this property, that means that this property is making you right around a 7.5% annual return. All you gotta do is take this number, how much you're making every single year, divided by the amount of money you paid for this property, the amount of cash you put in, and that's a 7.5% return a year. You as the investor now have to decide what is a good return for you. For me, when I'm investing in real estate, I'm looking for a minimum 7% return. So if I can find a property like this that's paying me 7.5% a year, I'll take it because I'm looking for a minimum 7% return a year, which means that every $100 I put in, I'm gonna be making $7 a year in cash flow every single year. If you don't have all $150,000 in your bank account to buy this property and you want to use some debt, now what you're going to do is you're going to be putting down a minimum 20%, which in this case would be $30,000. And now you put in $30,000, and then right here, after you got this $950, you're going to have to send some of this money to the bank. I'm going to use a red marker to talk about what's going on if you use debt. If you use debt now, you're going to put in $30,000 of your own cash, and then you're going to borrow $120,000 from the bank. Now what's going to happen is all of these numbers stay the same. So you have $950 a month in net income, and now you're going to have to send in some money to the bank every single month. If you're borrowing $120,000, assuming you can get a good interest rate, that means you're going to be sending the bank about $575 a month, which will leave you with about $375 extra a month after paying all of your expenses and after paying the bank. So now on a dollar-to-dollar basis, you're not making as much money here as you were here, but now you also didn't have to put in as much cash because in this situation, you invested $150,000 of your own cash because you bought this property all cash. In this, you only put in $30,000 cash and the other $120,000 was provided by the bank. So now you're going to be making right around $4,500 a year in passive income cash flow from this property. And now if you take this $4,500 and you divide it by the $30,000 in cash you put in, now this property is actually paying you right around 15% a year cash on cash because now you're making $4,500 based off of the $30,000 cash that you put in. The downfall here is you have a little bit more risk because some of this money is the bank's. And so if your tenant's not paying you or if you run into some other financial difficulties and you cannot pay this money back, then the bank might take this property back. They might foreclose on you. So you have a little bit more risk, which is why you want to see more return because you're taking on higher risk here with the higher debt. The next thing you want to know is how do you make your investment passive, because there's no way for you to scale this up as a real estate investor if you're spending all of your time managing one unit. If you're spending all of your time managing one unit, how are you going to have 5 units or 10 units or 100 units or 1,000 units? You have to remember that your goal is to be a real estate investor, not a real estate manager. A real estate manager's job is to work on all the day-to-day stuff. That is a job. Their job is to make sure that the tenant is paying the bills. Their job is to find the tenant. Their job is to pay the taxes. So a manager's job is to do the day-to-day work. The investor's job is to find the asset and own the asset. What you want to do is be the investor, because the investor is the person that's getting the cash flow. The manager's job is to manage the day-to-day stuff. So what you want to do is, once you find a property that you want to own, you want to work with a property management company who's going to do all the day-to-day stuff. Now, for this to really be passive, you're going to have to jump through this hoop, this hurdle of learning how real estate works. That means finding all the team players, knowing how real estate works, finding the right areas. Once you get over the hurdle, which is going to take months at least, it depends on how much time you're really involved in real estate, but it's going to take some time for you to understand how real estate works. Once you got a few deals under your belt, it's going to be much easier for you to make it passive, but you have to work with a property management company. It kills me inside when I see people saying, yeah, I want to be a real estate investor, and then they tell me that they don't want to hire a property management company because now they're losing out on an additional $75 a month, and now they're the ones that are getting calls from the tenants, they're the ones that are paying their bills, and they're the ones that are stressing about how they're going to find a new tenant. And if you really want to be an investor, you got to figure out where you want to spend your time. Do you want to spend your time working on all the day-to-day stuff, or do you want to spend your time trying to figure out how you can source more deals? This is where I want you to have the growth mindset. That way you can think of ways to grow the pot. How can you make more money instead of just trying to figure out ways on how to squeeze a few more pennies, right? I want you to think about adding more dollars rather than just thinking about pinching pennies. Now, going back to what I said earlier about why wealthy people love investing in real estate, one of the reasons why they like investing in real estate is because of the tax breaks that you get. So let's go over some of the tax breaks that you can get. So going back to the single family home that we talked about, let's assume that you bought it for $150,000. If you bought this property with debt, you will make, after paying your debt, about $4,500 a year in profit. If you didn't have any debt, then this property would be paying you around $11,400 a year in profit. This is the money that you get to put into your pocket after all expenses. So this is if you have debt, this is if you don't have any debt. The next thing, what the IRS says, is that if you own real estate, you get to depreciate the value of this real estate. So you bought this property for $150,000. You get to depreciate the value of the property on your taxes. In this case, what that means is you make this money, but then when it comes time to paying your taxes, you get an extra deduction. In this case, you will get an extra $4,700 deduction. And so now when it comes time to you filing your taxes, here, if you had debt, you put $4,500 in your pocket. And normally, if you make $4,500, you got to pay taxes on all $4,500. But because this is real estate, you get to depreciate the value of the property. And now you get to take a $4,700 deduction, which means, yeah, you put $4,500 in your pocket. But in actuality, your tax bill is going to say that you have $0 in taxable income, assuming that you have this. If you go this route with buying the property cash, now you made $11,400. This is how much money you put in your pocket, but you get to tell the IRS, hey, I'm only going to pay taxes on $6,700 because you get this extra tax break because you invested in real estate. Now, if you're wondering how I actually calculated this number, what you do is first you have to separate the value of the property and the land. And so what I said in this example is that the property, the actual building, is worth $130,000 and the land is worth $20,000. So now you take that $130,000, and again, this is just estimated, and then you're gonna divide that by 27.5. So that's just what it is for single family homes. If you're investing in residential real estate, you take the value of the property, you divide it by 27.5, and then this was right around $4,700. And this is how big of a tax break that you get every single year for 27.5 years for residential real estate. It's a little bit different for commercial, but the same concept. And so the bigger the property you get, the bigger the tax break that you get. This is why so many wealthy people love real estate, because now you can make money and pay no money in taxes, and it's completely legal. And this is where things get even more fun, because now let's assume that you bought this property for $150,000, and now time goes on and the value of your property doubles. So now this property used to be worth $150,000, now it's worth $300,000, and now you decide to sell. Well, this is where things get interesting. Because if you'd sold this as a stock, if this was a stock that you bought and you spent $150,000 and your stock market investment doubled, now you have to pay taxes on all $150,000. Even if you took this new money and you reinvested it back into the stock market, you're also going to still have to pay taxes on this $150,000 of profit. Well, with real estate, it's a little bit different, because you get this other loophole, this tax loophole called 1031. Again, although I am an attorney, I'm not your attorney. So if you have specific tax questions or legal questions, talk to a professional in your area. But what 1031 says is now, hey, you made profit on this real estate deal. But if you take this new money, you take this new $300,000 and you go out and you buy a bigger piece of real estate, which is going to generate you more cash flow, more tax breaks, Well, now you don't have to pay any money in taxes on your profits today. Why? Because, well, real estate gets big tax breaks. This is what the tax code says. It's called 1031. So now you can own your real estate. You can generate cash flow. You can get tax breaks on your cash flow. And now when it comes time for you to sell your real estate, you can sell it for a huge profit and pay no money in taxes today. And you can flip this into a bigger property, which is going to pay you with more cash flow. This is why wealthy people love real estate, because it's a way for you to generate cash flow, it's a way for you to build wealth, and it's a way for you to keep your wealth. Now again, the key for any of this work is you got to start with one deal. You have to start with one unit. Once you own one unit, then you can go to 2, then 3, then 4, then 10. You have to start somewhere. Everybody starts with 0 deals, and you have to start somewhere. So the best time to start is now. The last bit that I want to caution you on is that although this all looks good and it makes sense, you are going to run into your own issues. Every single real estate investor has one horrible deal. I've had mine. I even talked about it on YouTube, where I went through my worst real estate deal ever. Every real estate investor is going to deal with bad deals where you have to deal with a bad tenant, a bad property, a bad something. This is something that every real estate investor has to go through. And so there will be times where you lose money, but you have to remember that this is something that you just have to go through. That way you can get to the positive cash flow. Thank you for watching. If you enjoyed this video, here's the video on how to build wealth by investing your money that I think you'll love. And while you're at it, download our free guide on how to generate passive income. And as always, keep hustling. So the first thing you gotta understand is what sells a home or what gets a home leased out. That's kitchens and bathrooms. If you do decide to make upgrades in a rental property, those are the two places that get a lot of attention, kitchens and bathrooms. So if you do decide to make renovations, look at doing things there.